Manulife and China Bank. Two companies you can trust. Two top institutions in the financial industry. Teammates, partners, working together to handle every aspect of your finances. From day to day to your future plans. Personalized to your story. So you're ready for life's every twist and turn. We have you covered. Starting with your kids' dreams to providing a secure future for your family. Working to build your wealth and ensuring your wealth works for you. Always with you in sickness and in health. Through the best times and the worst. All just for you. Let us be your partner. Manulife China Bank Life. Life with a plan. Let us help you get started today.
You deserve the best life. You work hard. You know the formula for success. Your options are wide, but few make the cut. We can help you make the most out of life. Because you deserve the privilege that comes with building an elite life. Introducing Manulife China Bank Life Affluence Max Elite. This one-time investment in life insurance plan provides you with a startup bonus that would optimize your funds on the onset so you can enjoy rewards now and in the future. Experience the Manulife China Bank Life Advantage. Let's say you put in a one-time investment of 1 million pesos. Manulife China Bank Life will give you 1% of that as a startup bonus. This increases your investment by 10,000 pesos. Get a loyalty bonus. If you stay invested, you may have the chance to get a loyalty bonus on the 10th, 15th, and on the 20th year. Enjoy hassle-free application through a guaranteed issue offer. This means that there would be no need for medical examinations if certain conditions are met. Get a boost on your investment by making additional investments anytime. Enjoy peace of mind with life insurance coverage. Invest through Manulife China Bank Life Affluence Max Elite. Get an early reward and look forward to more.
Manulife and China Bank. Two companies you can trust. Two top institutions in the financial industry. Teammates, partners, working together to handle every aspect of your finances. From day to day to your future plans. Personalized to your story. So you're ready for life's every twist and turn. We have you covered. Starting with your kids' dreams to providing a secure future for your family. Working to build your wealth and ensuring your wealth works for you. Always with you in sickness and in health. Through the best times and the worst. All just for you. Let us be your partner. Manulife China Bank Life. Life with a plan. Let us help you get started today.
You deserve the best life. You work hard. You know the formula for success. Your options are wide, but few make the cut. We can help you make the most out of life. Because you deserve the privilege that comes with building an elite life. Introducing Manulife China Bank Life Affluence Max Elite. This one-time investment in life insurance plan provides you with a startup bonus that would optimize your funds on the onset so you can enjoy rewards now and in the future. Experience the Manulife China Bank Life Advantage. Let's say you put in a one-time investment of 1 million pesos. Manulife China Bank Life will give you 1% of that as a startup bonus. This increases your investment by 10,000 pesos. Get a loyalty bonus. If you stay invested, you may have the chance to get a loyalty bonus on the 10th, 15th, and on the 20th year. Enjoy hassle-free application through a guaranteed issue offer. This means that there would be no need for medical examinations if certain conditions are met. Get a boost on your investment by making additional investments anytime. Enjoy peace of mind with life insurance coverage. Invest through Manulife China Bank Life Affluence Max Elite. Get an early reward and look forward to more.
While waiting for our program to start, may we invite everyone to answer our poll questions flashed on your screens right now. MCBL will be raffling off 5,000 pesos worth of Sodexo gift certificates. Something to look forward to at the end of the webinar. Thank you. Good afternoon again, everyone. I am Wami Havaliana, welcoming you to MCBL's Growing Wealth Beyond Borders. Do you know that there are different types of investments? My personal favorite is an investment-linked life insurance program. because this plan gives life protection, coverage, and the possibility of higher returns in the future. This is also known as a variable unit linked plan or a VUL plan. Now, some of these VUL plans can provide a stream of income payouts that you may use for emergency purposes. Along with that, you have the freedom to choose where you want to invest a portion of your premium. It can be invested locally, globally, or even across asset classes. And investing in offshore funds can offer you a host of benefits, from increased protection of your wealth to potential tax advantages. I'm sure you'll want to hear more about this. That's why we invited two subject matter experts this afternoon. Our first guest will help us understand what investment-linked life insurance is about and how it can help us earn and save more when we invest in offshore funds. Our second guest will talk about the market outlook for 2021 and Manulife fund performance. Throughout the program, if you have comments or questions for our speakers, go ahead and feel free to send them via the Q&A box at the bottom right-hand side of your screen. Later on, our guests will address these questions or some comments in the Q&A session. Okay, now, let's get right into the meat of the program by introducing our first speaker. He's the president and CEO of Rampver Financials, a serial entrepreneur with companies and endeavors in multiple industries. He is the lead independent director of Globe Telecom and of Ayala Land Logistics Holdings Corporation. He is an independent director for Ayala Land and for the National Reinsurance Corporation. He is also the chairman of the Soldivo Funds and the director of Esquire Financing, Seedbox Technologies, the Blue Leaf, the Colinan Group, and the Mobile Group, Inc., to name a few. He is also a best-selling author and a business, leadership, and financial advisor and mentor. Ladies and gentlemen, please welcome Mr. Rex Mendoza.
Good afternoon. Thank you so much for that introduction, Wami. Thank you, and thanks to everyone for being with us. You elected to make us part of your day. It's a Friday afternoon, and there are a lot of things to do on a Friday afternoon, but you chose to be here. And for that reason, it is our job to make this an enlightening learning experience for all of you. And hopefully, there would be very valuable insights and takeaways that you're gonna get out of this. So, my topic is growing wealth beyond borders. Is it a good time to talk about this? There's been, a lot of debate on that. You think about investments, Rex, at this particular time? Why? Aren't we supposed to just hold on to whatever we have, make sure that we're pretty safe, and wait for the dust to settle and to be able to look at opportunities to invest again sometime down the road? Why think about this today? My next slide will show you why. Certainly, next slide, please. Certainly, there is always this debate about growth and risk. It's almost like we can take growth, put it on the back seat at times when the economy gets rough. We all know that's not supposed to be the case, because what we have should be a balancing act. Yes, we never control the environment, but we control ourselves. We will have to control our responses to the environment. And why is that so? Because achieving financial objectives doesn't only happen when the market is good. We have to achieve the objectives we want to achieve at the right time, and that's not actually going to be focused on good markets alone. We have to be able to hit them right on the mark when they need to happen, whether the market is good or bad. So regardless of the situation, we have to achieve our goals. So the management of our finances, the management of our investments happen whether the market is going well or not. The other point is the fact that perspective changes when you have a very different horizon. See, many of us are really scared and concerned because we're looking at what's happening today. And maybe that will persist and fester in the next few months. But think about it, end of the year or even end of next year, the storyline would probably change as more and more people get vaccinated. So, in the end, it's a matter of discipline and strategy. But as I would like to discuss this, nonetheless, there is a must that we'll have to look at global economies. We have to look at how things are going. So my next slide will tell you that there are common thematics that we're going to see. I mean, you can hear this from, a fund manager in the Philippines, a fund manager in Hong Kong, or maybe even a fund manager in the US and the UK. There are four themes that everyone's going to be having in terms of business outlooks for 2021. The fact that, number one, this is going to be a year of two halves. Why a year of two halves? Because the first half of the year will be so uncertain. We see surges in COVID infections. But on top of that, we see the start of the vaccinations. We see the start of the inoculation. So certainly, the first half of the year will be volatile. There would be a debate between people who think things are going to get better and people are going to be saying things are going to get worse. And we cannot say who's going to be correct between both of them. However, the next part of the year, as we see more and more people get vaccinated, the storyline will change. And obviously, as I get asked by a lot of people, I tell them I'm not exactly a strategic optimist, but I can tell you, and I can, probably surmise that the last 6 months of this year will be better than the last 6 months of last year. And why am I saying that? Because last year, there was no vaccination. Not one individual was vaccinated in the Philippines in 2020. So if you're going to be looking at 2021, I don't care if it's going to be 1 million. I don't care if it's going to be less than 5% of the population, but it's still more than what we had last year. So it will be better. The next trend and the next thematic will be a talk about a K-shaped recovery. Yes, we don't talk about V-shaped, L-shaped, and U-shaped anymore. It's going to be K-shaped. And K-shaped is exactly, manifested by this, that there are industries and companies that are going to be doing well, and there would be those that will be lagging behind. Obviously, those are going to be leading the pack are those that are in technology. Obviously, we're all about digital now because we're stuck to our homes. There would be retail, essential retail, and lastly, software services. However, other businesses and industries like travel, tourism, hospitality, even those that are concerned with food services, obviously the malls are closed. They're going to be lagging behind, and it will take a bit of time for them to recover and follow suit. So you're going to be seeing this concept called K-shaped recovery moving forward. The third thematic will be inflation. Yes, governments are pumping cheap money into their systems. They're going to, in the Philippines, we call it ayuda. But in other places, it's a stimulus, it's a handout, it's cheap money given by governments to alleviate, the plight for their citizens. That will be inflationary. No matter what we do, that's going to be inflationary, which leads us to the fourth thematic, which would be the quest for yields. Certainly, you will be worse off if you're going to be putting money just solely in low yielding and safe financial instruments, because obviously inflation will be eating most part of that kind of value. So technically, you're going to be losing money while you keep it. And that's the reason why there is a quest for better yields while people are looking at somehow a reasonably, risk-laden instrument that they can still manage. So these are the four thematics. But what is driving the global economy? The global economy is going to be seeing a surge this year. Obviously, last year was the most pessimistic part of the last 5 years. Next slide, please. I am going to, probably assume that different countries will obviously be bouncing off from that low. And when you bounce from that low, what happens? There would be strong recovery before it simmers down and normalizes in 2022. So what are the common issues that will be present and will be, the order of the day for many countries? As I've mentioned, continuous stimulus support, but the sovereign debt stock will increase because, countries don't have that kind of money. Not all countries do, and we're just one of those. So we will have to borrow. If we're going to be increasing the level of help and the level of aid that we're going to be giving our countrymen, we will have to borrow this. And many countries are like us. There would be a compounded difficulty in our debt service. And we see that in many countries. But it's all sovereign. So basically, if it's going to be internally sourced, then it's going to be fine. But many countries like the Philippines would now be sourcing dollar loans or loans from, outside their jurisdictions, which means their balance sheets are going to be imperiled. As a country, there are question marks with regard to that kind of practice. But the push will be for the virus control imperative, the vaccinations, and certainly on the industry side, a restructuring for productivity. So if you're going to be looking at it, in summary, there would be three drivers, three things that were, on the lookout for the global economy. Next slide, please. And these three things are as follows. This is the growth rate for the global marketplace. Global would be at around 5.2. You'll see the United States at around 3.1 in 2021. You're going to see the highest numbers where? In Asia. In Asia, we're expected to rebound, and that would be a solid 8%. However, that's predominantly driven not by the Philippines, but by China. China is part of this group, and China is actually pulling this group up. And I will show you later on the kind of numbers China has. So basically, this is a global trend. It's all about growth. And as I've said, very strong growth at the start, simmering down at the tail end of 2021 and probably 2022. So again, the three things that would be driving the 2021 first half expectations would be the next slide. The economic rebound is going to accelerate. It's going to be all above trend because obviously the baseline for last year was really low. We were starting from the crash of 2020 March. And obviously from this year, first quarter to that year, moving on to the second quarter, there are many places where, can just imagine, I've mentioned China. The growth in the China GDP is fantastic. It's over 18%. It's 18.3%. That's not exactly the same way for the Philippines because we got ourselves into another surge, and because we did a strict lockdown starting March again, a year after we did it last year, we were kind of pulled back as far as the economic rebound is concerned. High liquidity through fiscal and monetary stimulus, that will persist. As I've said, they won't care about inflation. They will help their, suffering population. Many countries will do that. And lastly, turbocharge structural trends. So we're going to be all about digital. It's going to be all about all online. Sustainable investing is going to be a focus as well, and e-commerce. So there would be, as mentioned, revenge spending and maybe revenge traveling for some of the other countries. Unfortunately, let me mention this, for the Philippines, it's going to be a bit delayed. There would be what we call a reality bite scenario. Next slide, please, where the Philippines is going to lag behind. Now, I am not saying we're not going to recover. We are going to recover. It's just that we're going to be a bit delayed than many others, including those countries that are our ASEAN neighbors. So our restart and recovery may take longer than expected. We backtrack because of the ECQ and the surge that we've seen. We're recovering from that. Hopefully, this would be a continuous opening up and we don't have to pull back from there. The recent infection surge has really impacted our recovery trajectory. Now, the question is this: the pace of vaccinations taking much lower than ideal and is in need for acceleration. Just imagine the kind of vaccinations we're having currently. It's all LGU driven. The private sector is not in the ball game. Maybe they'll start doing that. They'll start being in the game by about June or July. But I guess clearly, if you think about 10,000 vaccinations in any given day, we're probably going to be hitting what? 1 million by the end of the year. And that's basically just 1% of our population. That's very, very far from what we want to have, which is herd immunity. And herd immunity is 70% of the population. And as we speak, there are countries that are very close to that already. And you will see the trend in their infection. So basically, a very sad story for the Philippines. But again, I will always say there would be a bright time. Maybe you and I cannot just pin it down, but it will happen. But it will get pushed back. And as investors, we'll have to do something about it. We will have to do something about it. Next slide, please. You will see that picture of that surge. That's very real. It has happened. And I guess what's telling is the next slide. If you are going to be looking at that other chart, you're going to see us getting compared to our neighbors: Indonesia, Singapore, Thailand, Myanmar, and Vietnam. Next slide, please. You will see us getting compared to those other countries in terms of new cases. In terms of new cases. So while the other countries around us are increasing their level of vaccinations, where infections are getting lower, the Philippines suddenly got into a second surge. Starting March, hopefully things are simmering down today, but since the vaccinations aren't in the ideal pace, we are going to be seeing this to be a persistent issue. So how does that impact our market? Take note of what has happened to our market from a very, very confident January. Next slide, please. A very, very confident January, you will see us drop 15%. Okay, and that's off Friday. I mean, if you're going to be looking at, that kind of a drop is 15%. That's just the start of January. January, we were thinking this year is better. But all of a sudden, a drop of 15% because March and April weren't as good. Again, we went back to those stricter lockdowns. But let me put things in perspective. This is where I sometimes see people needing the kind of information, needing the kind of confidence boost. Because people sometimes don't look at investment horizons correctly. When you're going to be looking at short-term gyrations like this, it will essentially spook you. But if you're going to be looking a bit farther, next slide please, you're going to say, hey, 15% drop, that follows a 53% recovery from the drop we have in March 2020. That was a 53% increase. So a 15% retracement from that is not exactly bad. Markets don't have to go up on a very parabolic mode. Parabolic recoveries are not sustainable. So the market always has a reason for correcting a bit to gather more muscle to grow again. It just became so comfortable and so timely that a surge happened and it gave people a probable reason to expect the market to correct. But on top of that, we have to talk turkey here. We have to talk facts. Much of the reason also for the drop is an MSCI rebalancing. So it's not exactly economy driven. It's actually an investment, platform and an investment index drive. Many of our companies were lowered. The Philippines exactly, had to be sold down by foreign fund managers because some of our companies got a lower weighting in that index. And as you know it, if foreign fund managers sell, our markets go down because we don't have that kind of volume. So that's the reality that we'll have to contend with. So you'll have to see that growth isn't exactly that bad. There has to be a correction that follows it. If you're going to be seeing projections in GDP which is the next slide, you will see that we're also supposed to have our own surge, right? But that's going to happen on the third quarter. Cannot be the first quarter. The first quarter still had a good January and February last year. While we had the Taal eruption, January and February of last year were open economies for 2 months. We only had that quarantine restriction by March. However, going into 2021, we had a relatively open, but still not the same way as January and February of last year, but a bad March. So that's the reason why you see still a negative compared to last year. In fact, the expectation was negative 5.4. We're only minus 4.2. So it's still, higher than expected. But hopefully, the third quarter will give us a good bump, and that will simmer down to about 5% growth by the fourth quarter. Next slide, please. So the quest for investors shall always be resilience. We all have to have resilience. It is the capacity to recover quickly from difficulties and the capability to thrive despite the odds. We can never make an excuse out of the economy for our financial goals. You're still going to educate your children. You're still going to give them the great education they deserve, whether or not markets are good or bad. You're still going to retire at a certain age, at a certain year, whether that trajectory has been laden with bumps like a COVID pandemic. So the recourse is not to look outside and see what's happening, but to look inside and see how we maneuver. And that gives me, the opportunity to discuss the concept of asset allocation with you. Next slide, please. The concept of asset allocation states that, we don't actually invest to make more money. We invest to achieve financial goals. And since most of those goals are actually long-term, blips like the COVID pandemic is always going to be part of expectations. The volatility, the bumps like 2008, 1997, they will always happen. But even if they do happen, the question becomes, what should we do about it? So if it's a journey where you want the resilience, you'll have to do something about it. You'll have to focus on the goals that you want to achieve and the kind of strategy that you can have in terms of your investment behavior, your investment journey. That's going to get us to where we want to go. So what is asset allocation? Let me define it for you. Next slide, please. Asset allocation is the investment strategy that, invest in different asset classes. You're not supposed to put your egg in one basket. We've learned that very early. However, we also have to know that all of these assets don't react or perform the same way in any given market scenario. Time deposits, stocks, bonds, managed funds, real estate, insurance, and cash, have to be part of a portfolio that balances risk and reward based on an investor's risk tolerance, time horizon, and goals and objectives. In fact, does that mean that we're going to be having these asset classes only in a given geographic situation like one country, the Philippines? Or is it high time we also go out and participate in other economies and other markets that might do better? I think that's a question that we'd want to be able to answer today. But let's look at all of these considerations. Let's look at consideration number one, risk appetite. Next slide, please. So because there is such a thing as a risk appetite, it will have to be a conviction amongst all of us that we have a degree of comfort in what we want to invest in. We are going to be, absorptive of a certain level of volatility only. But there is what we call a risk versus return efficient frontier. So much so that you get to increase a level of risk, then there is a supposedly matched level of increase in terms of return. And you will see that over a certain spectrum, that efficient, frontier is something that you'll have to heed and take notice of. Because if you're just going to be taking risks excessively, then you might put yourself in a precarious situation, because we all understand higher risk, higher reward. So if you're running for the reward, you're actually taking more of high risk. But if you're going to be too safe is not good as well, because you're going to be losing on a consistent basis, because inflation is going to be eating up the value or the purchasing power of your money. And aside from risk appetite, we also have another major factor also in, balancing growth and risk, and that's called, a time horizon. An investment horizon, the term of your investment. Next slide, please. The time horizon is very important in a sense that it has to match your life cycle. If you're younger and the way you've laid it, within a journey is that you're going to hit certain financial objectives like 10 years, 15 years from now, then you can be a little more growth focused because you have the time, you have the runway. However, if you're about to retire in 3 years, 4 years, can you still take that kind of risk? Or are we supposed to dial down on growth instruments and push ourselves into defensive instruments? So it will now be a function not of our risk appetite, but it's also a function of the soundness of the kind of risk we can take because of the age that we have, because of the time that we have in order to, hit the goals we want within our investment journey. So as we get on with this, next slide, please. We also have to realize this one major point, and this is something that I give as a warning to a lot of people who get to listen to me, because, as the markets become more retail driven. Next slide, please. Markets are more retail driven. People think they can do DIY all the time or do it yourself, where they can invest in direct stocks, they invest in, even offshore instruments by themselves, creating a massive flow of funds into self-driven, self-decided portfolios. I'd want to be able to tell them, hey, it's a fact. 90% of people who directly trade lose money. It's a real fact. 90%. And why does that happen? And why do all the statistics point to that? It's because in reality, any long-term portfolio, the performance is driven by asset allocation. All the researches I've seen, the lowest is about 65% attributed to asset allocation. This particular research that I'm showing, this pie chart, will give you 91% asset allocation driven, where security selection is only 5%, market timing is 2%, and other factors 2%. So why are people taking too much time trying to invest on their own? Let me tell you why. Because it's exciting. It gives us a lot of, a satisfaction whenever we make moves and, it just works for us. It's exciting. However, because it's our decision, and sometimes when it gets to a fluke, we also sometimes cannot forgive ourselves for doing that. And regret always happens at the tail end of this. Let me just give you an example. I mean, we all know technology globally is the thematic to invest on. But you see, there is a difference between a professional fund manager looking at the technology space, looking at brands that we all know and understand, looking at actual performances, and even companies that back them up. As retail players, we're only exposed to the names themselves, like Microsoft, Apple, Tesla. You can even think about very popular names right now like Square, and companies like those. But you see, when it boils down to fundamentals and people don't know fundamentals, you will never know what's hyped and what's real valuation. That's the scary part. And if you don't know that, can you actually match your future goals with this kind of an investment practice? This morning I just shared a particular infographic to a lot of my friends. As I do this most of the time. If I get to get information like that, I push it over Viber. I post it by doing a YouTube video. I also do blogs right now because of what we're seeing today. I mean, that's the only way I can touch base with a lot of people. And this morning, what I mentioned, for all the other companies that are now getting the attention because of technology, I tell them, hey, don't you know that Apple is the real name when it comes to real valuation? And people get surprised because I put companies like, Square, companies like, in a given spectrum, the companies that are getting to be so popular, right? Followed through by the pundits, as we call them, the retailers. Out of a list of 10 companies, Apple earpods. We're talking about earpods, not even the iPad or the iPhone. The earpods. The earpods outsell more than 5 of the companies on that top 10 list combined. Just earpods. That just gives you the kind of fundamentally driven sales information that we all need. But again, we're not analysts. We're not going to get that every day. But we're going to be investing every day based on what we hear and based on what we read. And that's going to be the precarious part. Next slide, please. So diversification is a must. Whether you are going to be in a bull or a bear market, you want to increase your portfolio resiliency, you have to diversify. And if you're not going to get anything from my whole talk this afternoon, if you're going to forget everything, this is something that I just like you to remember. This is something that I'd want to resonate with all of you. This next slide is going to be very busy, but let me explain it. Next slide, please. You're going to look at this slide, and as I've said, it's very busy. These are 16 years. 16 years of markets from 2006 to 2021. You're going to be looking at the top square. That's the best performing asset class for the year. So 2021, best performing US equity. 2006, Philippine equity. 2013, US equity. 2018, US fixed income. So you're going to see asset classes that are very different here. Asian equity, global fixed income, Asian fixed income. Okay? Commodities, gold. They're all here. What does this tell you? Just by looking at the colors, there is no consistent performer. There is no consistent performer. And as I can say, okay, the Philippines was what? Top performer in 4 out of the 16 years. It's also a laggard. Last 2 places. 5 times in the last 16 years as well. The worst thing is this. From 2018 to 2021, the last 4 years, the Philippines is considered a laggard. Last 2 strengths on that chart. So what does that tell you? To be exposed in a given market, in a given asset class, is going to be very, very dangerous. It is going to be very, very dangerous. And it also gets to hamper your performance, especially if you're not cognizant of your timelines. Can you just imagine, ladies and gentlemen, you're about to hit retirement in 2020 and 2021, and you're too heavily involved in Philippine equities. The last 4 years would have been detrimental for you. So the key is to do asset allocation. The key is to be involved in other markets. Because we don't know what's going to perform. And we have to make sure that we have the right diversification. And asset allocation will be the only thing that gives you that. Next slide, please. Look at the global vaccination campaign. You don't even see the Philippines as part of that slide. So if we're going to be too exposed to a given market and we're not diversified, then we're always going to be in danger. Let me focus on this next slide. Next slide, please. Global growth in 2021. Look at it. Global growth is going to be on a consensus 5.7%. with Fidelity saying that the upside is 6.9 and the low side is 4.1. Look at the US. 6.2 would be the consensus, and that's going to be between 9 and 5 as far as Fidelity is concerned. China, 8.5. The median would be 9 and 7. The forecast now is that China is going to be ending up at a very high 9, very close to a 10. The Philippines will not have these kinds of numbers this year because obviously we're really delayed in our vaccinations. And on top of that, we really are hampered by the kind of surges that we're experiencing, not just in the metropolis, but in the provinces. Next slide, please. The global markets will actually improve substantially because of the savings rate that is going to be fueling a recovery. You're going to be seeing household savings rate, the orange to be 2020 and 2021 to be your blue line. So people are saving more money during this pandemic, and that's going to drive what you call reverse or revenge spending, reverse or revenge travel moving forward. Steep accelerations. Look at what's happening to the US, the US business cycle. Next slide, please. Look at that kind of an economic index. Look at their manufacturing and non-manufacturing ISMs. That is going to be the cornerstone of, the Biden presidency. And Biden would like to fuel this moving forward. He wouldn't really want a dip. And I guess, the vaccinations that they're doing in the US, even giving out, as we learned from many of the tidbits that we're getting in terms of news from the US, they're even doing lotteries and raffles for the people who are getting vaccinated. You can win $1 million just by being vaccinated. In the Philippines, we want to be vaccinated. We don't even, get them administered, right? Moving on to the next slide, look at the US business cycle, consumer spending and retail sales as expected because of the reopening. Look at the personal income by component. Those charts are very powerful. And their main competitor now for the global economy is China. And China is holding on its own. And I guess everything started with China, right? As we're talking about this COVID pandemic. So who recovered first? Obviously, China as well. I don't know, but you probably read about all of those conspiracy theories. But whether they're true or not doesn't really matter. China, economy-wise, is standing on solid ground today. Next slide, please. Look at the new robust structural drivers underpinning the new China. Consumption upgrade driven by the rising middle class and increasing urbanization rate. They're now becoming driven by their mega cities. And I guess we see surges as they open up. The Hermes outlet in Shanghai registered by far the highest single sales or revenue generating day globally in recent times because of opening up. That's the revenge spending I was talking about. Technology in China is an enabler, and it's actually creating new business models with Tencent, WeChat, Alibaba, and all that. Moving forward, look at the numbers of China. Look at GDP. Next slide, please. Look at the GDP, as I've said. First quarter, 18.3%. That simmers down to 9, 7, and 5. But the average of that is 9.8. And you see a surging industrial production growth. Once countries open up, China will be ready to supply the world with its goods, with its production, because it's doing them today. The inventory levels are rising. There is also a backdrop for a solid consumption recovery. Next slide, please. For China itself, they're not going to be dependent on exports alone. They're going to be focused on their own internal markets. Look at the kind of household savings that we're looking at. As of now, 37%. Even before COVID, the Philippines did not hit a savings rate of 20%. That's unbelievable for us. It's going to be incredible when we get to hit that. But China is hitting it on a normal clip. Look at the kind of unemployment rate, you know, decrease that you're seeing there. So they're building up and expanding as we speak. The growth, as mentioned, GDP breakdown would be a 9, and the expectation for 2022 will be between 6 to 7, which is still a big number, you know, knowing the kind of base that they have. So all told, ladies and gentlemen, what should we be doing? What should we be doing? I guess it's a comprehensive way of really managing our wealth, comprehensive way of managing our personal net worth and estate values. Next slide, please. So if we're going to be seeing this is the way we should go. We have to look at everything that we have, and we have to focus that balancing growth and risk, tax leakages and treatment, access and liquidity, and distribution. Wealth management is a full-scale needs-based management that assists individuals and families in 3 stages: accumulation, preservation, and transfer of wealth, by customizing the right product solutions to meet goals and objectives. And I guess you've been invited here by your friend from MCBL. Why? Because it's a very good time to think about doing something about this when you haven't done enough. It would be a time to revisit the strategies that we're making in order to get our investment journey on track. So let us look at how we have really allocated our assets across multi-classes and markets. Next slide, please. And we don't have to wait. Are you going to wait for things to get better? Let me show you what's happening to the US right now. That kind of graph will tell you, next chart please. That kind of graph will tell you how vaccines work. That's the kind of drop in terms of infections you're going to see, because they're really making their vaccinations available everywhere and within reach by everyone. And it's not just the US. Next slide, please. Look at the UK. Look at the vaccination rate of the UK. The blue on the left-hand portion of your screen and the blue at the right-hand portion of your screen. Look at that kind of drop in terms of infections. It's going to be fast. It's going to be swift. If you don't move today, you're going to be left behind. So the key is acting upon the stimulus and the information we all have. You know, I mentioned this. This quote comes from John Templeton, one of the pillars and hallmarks of the mutual fund industry. And he has said that bull markets are born in pessimism. They grow in skepticism. They actually mature in optimism, and they die on euphoria. You have to be ahead of the curve. And we've seen this many, many times. I've seen this in the 1997 Asian crisis. I've seen it in the 2008 global financial crisis. 4 or 5 years later, what do my friends say? Sayang, Rex, no? I should have invested in 2008. Sayang, I should have invested in 1997. Those are the 2 words we often hear 4 or 5 years after a crisis. Sayang, sana. And we're going to be hearing that 3 to 5 years from now, because that's real. History repeats itself endlessly for people who are not willing to learn from the lessons of the past. Next slide, please. If we don't learn from the lessons of the past, it's such a waste that we went through them. We should be able to pick up the pieces and move forward. And the best way to do that, as Wami mentioned, may be to put yourself in an investment instrument that will have a best of 2 worlds that are very important to us and in our financial journey moving forward. Next slide, please. And that's the VUL policy. VL policy gives you both the insurance coverage and the investment proposition. I know that for some of you, this product would probably having been given a bad press, but that's okay. I mean, I understand. Obviously, there can be naysayers in any given situation, but I can say this without batting an eyelash. There is no perfect investment instrument. There is just one something out there, one investment instrument out there that matches you and your need at this particular time. That's very important. And for what is ever said about the VUL policy, it just tells you that it carries a downside cover, which is your life insurance, and the propensity to earn more because of its investment proposition. And I guess the most important part here would be the choices it gives you. Next slide, please. Because of this combination, you will be having many different uses for this, and you don't even have to decide what that use is, because you can have that option later on to swing it to a child's education, make sure it can give you guaranteed income when you retire, and all of these other needs that can be there once you get into forks on your road in terms of your financial journey. It will give you the discipline, the diversification, the help of investment expertise, because that investment component is driven by people who have it as a 24-hour job. They are trained, they are educated to invest, and they are on the ground compared to us that probably would be doing many other things, and we're not even attached to the market itself. So we're going to be quite delayed in terms of an information access, and we're also going to be having issues when it comes to other things like currency, credit exposure and stuff like that. On top of it will be service. This is not a combo from your fast food chain. In McDonald's, you buy a combo and you consume it in less than an hour. That's the reason why you don't need follow-through service from McDonald's itself. But for a financial product that will be there for at the very least 5 years to 20 years and even more, you need the follow-through. You need the guidance. You need the investment advice coming from someone who has it as a profession and as a full-time job. That's the reason why service is a great component of that VUL. And that's the reason why I guess I find it very important to say that's one of the biggest benefits. You're not buying a product, you're buying what a product does for you. But on top of that, you're also buying the service of that expert that invited you this afternoon. And on top of it, you're also buying the discipline to go with it. Because people who opted to do this on their own eventually don't actually have the discipline to follow through. So in cases where they go for the more efficient, cost-effective direction, they lose out on the total benefit because the discipline wasn't there. The other extras will also get to be discussed with you. That can be riders called critical illness, riders that can also match you up with health issues and stuff like that, and other benefits. Moving forward, next slide, please. All I can say is this, that diversity reduces adversity. Diversification is a must. Asset allocation is a must. And you really have to consider this moving forward. 2021 and even 2022 will be challenging years. These are all going to be challenging years. And next slide, please. Diversification and selectivity. Pivots in business. This will be strategic anchors for both this year and next year. Again, selectivity, diversification in investments, pivots and repurposing in business. We have to be nimble. We have to act with the information that we have in front of us, and we have to know how to maneuver in the fulfillment of our financial dreams, and most importantly, doing that for the people we love. And that's the reason why I always end with this slide. Next slide, please. I always end with this slide. That I ask people, you don't invest for yourself. You don't invest only to achieve the goals you want as an individual. You're doing this for people you love. You're doing this for special people in your life. So you have to anchor everything that you do in your investing with the special people in your life. Because if you do that, you're never going to be wanting in terms of inspiration. You're never going to be wanting in terms of motivation. You're always going to be grounded. You're always going to be in that direction that forges discipline, makes you make the right decisions. Because at the end of the day, it's not the money we get. It's the fulfillment, the achievements of the dreams we've set for the very people we live for. It's not all about having funds to live on, but making sure those funds are going to be correct and right for the fund to live for. And we think about that, we think about special people, not just ourselves, but the people we love. With that, ladies and gentlemen, I end my presentation. I will be back later on for a Q&A, but in the meantime, I'll be bringing or handing the floor back to Wami Habeliana for the next parts of this event. Thank you so much and good afternoon.
Hey, good afternoon again, everyone. Thank you, Rex. We appreciate your insights on how we can benefit from insurance plans that are linked to offshore funds. We will see more of you later during the Q&A segment. If there's one thing I remembered from your talk, you really mentioned that it is dangerous to remain in one asset class and in one geography at this point in time. So to the audience, if you have any questions for Rex, please just type them in the Q&A box at the bottom half of your screen and he will answer them later during our Q&A session. So now, before we move on to our second speaker, let's check out the audience's pulse on our poll questions earlier. It's very nice to see that our audience today is very interested in the topic. Now, our first question was, why are you saving up for investing? So there were three, answers, no? Retirement, wealth diversification and growth, and or health emergencies. And the top pick was letter A. 50% of the audience are saving up for their retirement. So everybody wants to enjoy their life after work. MCBL has insurance plans that can actually act as retirement funds. These plans guarantee lifetime insurance protection for you and your family while securing your hard-earned money. With regards to the other needs, wealth diversification and growth and health emergencies, MCBL also has other products suited for these needs. In terms of all of these needs, we can say we have got you covered. Now let's look at the second question. Where are you currently invested in? No? There are a number of answers, letter A to G, mga pito yan. No? It's very interesting that 31% of you said insurance. Very interesting. So that means if you're currently not invested, or if you're not currently investing your savings or hard-earned money, now is the time to do so. Investment in investment-linked insurance programs can see the potential for your money to grow. Please spend time, consult a financial sales associate to help you assess the right product suited for your needs. If you guys can spend time to do other things, you might want to spend a lot more time doing your retirement planning, as half of you have already done. Lastly, our third question. Do you know how life insurance or investment-linked life insurance works? So, dalawa lang naman ang sagot dyan. Yes or no? Huh? And a resounding 85% answered yes. But of course, after hearing the segment of Mr. Mendoza, I would probably guess that's close to almost perfect, or 100%. So once again, we thank you all, our audience, to those who participated in our activity earlier. Moving on, to update us with the latest market outlook and Manulife fund performance, let me introduce to you our next speaker. He is the head of wealth sales of Manulife Investment Management and Trust Corporation. He has more than 20 years of experience in retail banking and wealth management, is a chartered wealth manager, a registered financial planner, an SEC certified fixed income salesman, and an SEC certified investment solicitor. Join me in welcoming Mr. Zedric Matubis.
Thank you, Wami, for that kind introduction. Good afternoon, everyone. I hope everyone is safe today and enjoying the webinar so far. So before I go to the outlook, let's do a very quick scan of the fund performance of a few of the VF funds of MCBL. As you can see from this table, one word is key, and that word is divergence. So you can clearly see the difference between the performance of the funds invested in the Philippine economy against the funds invested outside of the Philippine economy. And there was a chart that Mr. Mendoza showed you earlier that that is in line with what's happening here, and clearly there's a big difference. So if you look at the year-to-date performance, for example, as of May 13, 2021, or end of last week, you can see here that all of the funds invested in the Philippine economy is still negative, while the ones invested outside of the Philippine economy, they're positive. And if you look at the full year, everybody's positive, but it's clear that the offshore funds are already double digit while the Philippine funds are not. No, and for example, you can see here our clients who invested in GTIF enjoyed a one full year performance of 21%. Our clients in APPI, or Asia Pacific Property Income Fund, enjoyed a return of almost 19% last year. And Asia First and ASEAN Growth, they're doing spectacularly well, both above 40% for the last year, while the Philippine funds are not doing as well. They have recovered, but like what Mr. Mendoza showed earlier, we're not really seeing spectacular returns as compared to their offshore counterparts. Now, will these funds continue to perform well? And to help answer that question, let's look at our outlook on investing in after COVID-19. And before I discuss this, I'd like to believe that there are changes that has happened in the past few months, particularly brought about by COVID. And these changes will certainly transform our lives in permanent ways, and therefore they will stick with us even after the pandemic. And these changes I can summarize into three themes, and their effect on the economy and the markets, and also how people can benefit from them, from these changes. So let's go to the first change and the first theme. And the first theme is on the next slide, is technological disruption. And in this theme, I will mention one major change. And that first major change is the great office exodus, or the people, more and more people working from home. So before COVID, less than a quarter of people were reported to be working from home. But after COVID, reports are showing that around 37%, or even up to as high as half of the employees, are all working from home to some extent. And in fact, in certain occupations like legal, business, education, and finance, they have reported around 88% of their workforce working from home. So this is really a big impact on technology, on the demand for data, et cetera, and for the demand for or the lowering of demand in terms of office space or real estate. So this has that impact as well. The second change on this theme is on the next slide, and it's about spending. And we see that more money is spent inside the house, or at home, or on the home, rather than spent outside of the home. So this trend actually in the US started as early as 2004, but COVID has increased the gap tremendously, as you can see from the chart, the discrepancy between the green and the blue line, green being online sales and blue being sales happening in department stores. And I believe that this is very similar to what we're experiencing in the Philippines. Although we didn't do online sale as early as 2004, but we do believe that our lives have dramatically changed in terms of spending, and more Filipinos are doing the same, buying stuff online rather than buying in malls. And I believe, and we believe, that this will continue to happen even if when lockdowns are removed, and simply because we have felt the convenience already. And even if COVID is not here anymore, even if we can go to the malls, we just if we have felt already the convenience of buying stuff online, then we will not be going outside as much anymore. The third change on technological disruption is on the next slide, and it's the demand for data. Work from home shifts the demand from office space to digital storage space. Video conferencing demands a decent bandwidth. In the field of healthcare, trends like telemedicine and contract tracing require a heavy digital footprint. In the field of education, we have shifted from going to school to remote learning. In the Philippines, for example, we have felt this. Companies, schools, even homes have now upgraded their tech and communications, hardware and software just to accommodate the data demand that is required in living in this new normal. So this is something that is also changing our lives. The fourth change in technological disruption is in the next slide, and it's about lean workforces. Manufacturers have been forced to rely more on automation, particularly during COVID, and this will linger on even after the pandemic, simply because automation is more reliable and companies have learned that lesson. Artificial intelligence and robotics will permeate general purpose machinery in areas such as food, healthcare, consumer goods, and e-commerce, helping to better insulate companies when it comes to future shocks like pandemics. So this will be something that will be prevalent as well. Now let's look at the second theme outside of technological disruption, and it's the globalization. And in the globalization, I'd like to mention two themes or changes inside this theme that we believe that will permeate or will be permanent in the next few years. The one is the change from global travel to more local and regional travel. We believe that there's evidence that travel will be more regional than global. Long multinational business junkets will probably be curtailed, while international vacations and cross-country trips will be replaced by outings closer to home. Like, instead of flying to the US, most Filipinos will be probably doing trips within ASEAN first and then probably Asia. And we believe that this will persist years even after COVID. And the second item on deglobalization is the decoupling of the West and China. Presently, for big countries in the West like US and even Japan and Europe, they import around 20% of their raw materials from China. And it is only prudent for them to diversify. And obviously, there will be looking for more suppliers outside of China moving forward. China, on the other hand, will also de-emphasize their reliance on Western markets. And like what Mr. Mendoza mentioned earlier, will be accelerating their expansion of their internal value chains and nurturing their growth within their economy. And they will concentrate more on consumption rather than on exports. So with this, China will truly transform its economy, and we've known China as the factory of the world for so many decades. They will change that, and they will become more of a consumption-driven economy as they become richer and wealthier, as more millionaires become billionaires, and their economy will now be reliant on internal driven factors rather than exports or trade in general. So the last theme that I'd like to look at is on the next slide, and it's about revisiting policies and priorities. And this is something that Mr. Mendoza also touched on earlier. He said that monetary policy and fiscal policy will be very prevalent in the next few years as economies try to recover from the pandemic, and we believe that in this space there will be change, because more and more economies are realizing that monetary policy will not be enough, and they will be moving to more fiscal policy. So this will definitely affect areas such as infrastructure spending, education, and incentives for low carbon tech development. So this will be beneficial to these sectors. And the last item on this theme is the growing demand for ESG, or environmental, social, and governance factors. More and more investors are not just looking at returns, but are also looking at corporate responsibility. Am I investing in a fund that buys stocks of companies that are not looking at the environment, or are doesn't care about the community? They're not looking at the interests of stakeholders like clients, employees, shareholders, the community, and environment. So if they don't, I don't want to invest in that fund. I want to invest in a fund that looks at these other factors. And as such, we have seen more than $70 billion net inflows in funds with some sort of ESG principles embedded with them, and that brought AUM to almost $1 trillion in these funds. So let us summarize the impact of these three trends, and that will be on our next slide. So we'll look first at the impact on the general or broad asset classes. So we believe that as economies start to reopen, as vaccines are rolled out, as more and more lockdowns are removed, we expect equities to experience a post-vaccine surge in 2021, just like what Sir Rex mentioned earlier. The US is likely to see some of the best macroeconomic data it has seen in years. Globally, not just in the US, but elsewhere, supportive loose monetary and fiscal policy stimulus policies should also help to drive equities higher. That's why we are preferring equities as a general asset class, as you can see from this chart. In terms of bonds, we are more neutral. We believe that bonds can offer some protection from market volatilities. However, low and very low negative rates are right now, very low rates, in fact, negative in some areas. This makes it very. This makes bonds very. The potential for bonds to provide opportunities will be very minimal. Further large-scale easing in rates is less likely now, given the very low rates that we are already. And in the last asset class that we're looking at, and Mr. Mendoza also touched on this earlier, is that the very low short-term rate environment that we have make cash, your money market, your time deposits, your T-bills, all of these short-term, semi-guaranteed funds, they become very attractive at this time, very unattractive this time because of low interest rates. And we believe that we will, as an investor, if you are an investor looking for investments, you should be staying away from cash, particularly your money that you want to invest in for your long-term goals. And on the last slide, I'll show you the specific sectors that will do well, given the three themes that I mentioned beforehand. So obviously technology, communications, and consumer discretionary will do well. And growth stocks in general will do well because of the trends that I mentioned earlier. But we do believe that we need to balance these with targeted positions in other sectors, like industrials, materials, mining, and financials, just to be prudent about it, because we believe that there will be certain values that we can find in in the companies in these sectors as well. So that ends my presentation. Wami, see you again later for the Q&A, and thank you, everyone.
And here in Manulife China Bank Life, where you're a seasoned investor or just starting to build your wealth, we have a range of programs that can help you grow and diversify your hard-earned money. The good news now is that we just launched 3 international new funds that you may invest in when you get a life insurance program with us. We now offer the US Growth Fund, a fund that invests in some of the largest and most profitable companies with stocks that are publicly traded in the United States. Some examples of these are Alphabet, which is Google's mother company, Amazon, Apple, and Facebook. A lot of us would say these programs or these companies are based in the US and wouldn't really be affecting us here in the Philippines. But right now, as we sit at home, you bring out your iPhone, you Google something that you want to buy, you see it on a website, you then get on Lazada and purchase it, you pay with Visa, These are some of the top companies listed in the United States stock in the United States, no, based in the United States. So all of these are, although based abroad, actually affect us here in the Philippines. So it's a very interesting proposition for us to be able to invest in something based abroad that affects us here. No, the Tiger Growth Fund that we have is the second fund. No, it's a fund that invests in innovative companies that are publicly traded in both China and Hong Kong. Samples of these companies are Alibaba and Tencent. No, very interesting. Alibaba, everybody knows, is one of the largest, if not the largest, online purchasing platform in the world. So they've really taken technology to another level. Tencent, if you don't know what that is, that's the one that does WeChat, WePay. But more importantly, it has influenced a younger generation of people who like to play games like Fortnite, Clash of Clans, League of Legends. They even invest in movies. And lastly, you'll have the option to go Global Preferred Securities Income Fund. No? This is when you link in an insurance program in this fund, and with exposure to high-quality securities issued by global companies in diversified sectors like banks, insurance, communication, and power and electric companies. Through these funds, you can enjoy life protection while growing your wealth from across the globe. So if you want to know more about our products and you have an existing financial sales associate, please schedule a call or expect a message from them right after this webinar. Now, for those without a financial sales associate yet, please feel free to get in touch with the China Bank or MCBL rep who invited you to this webinar today. Or you may reach out to us by visiting our website, which I believe we will flash on screen. There's a link, or you can use the QR code that you may scan to visit the MCBL website page. And once again, it's still not too late, dear audience, to hit that Q&A box and ask your questions from our speakers. Right now, we are getting a lot of great questions from the audience. I'm also excited to hear our guests answer all these. But before that, make sure to stay tuned until the end of the webinar because MCBL is giving away gift certificates worth 5,000 pesos. So let's watch out for that at the end of the webinar. Now, we're ready to bring back Zed and Rex on screen for our Q&A segment. Welcome back, Boss Zed, Boss Rex. Good afternoon again.
Hi.
Good afternoon. So, gentlemen, are you ready to answer questions that came out from our Q&A box?
Sure.
Okay. Is Boss Rex there? Okay. Boss Rex, this one's for you. For an average person, where investing seems complicated, so to the regular Pinoy, how do I start?
If we don't know enough, I think we have to make sure that the commitment is there to start knowing something. And when I tell people the very best way to know something is to have skin on it. I call it the skin in the game positioning. All I'm saying is this, Wami, if you're not investing in something, there is no propensity for you to really be motivated to study it. So the key is to start. But it's a very precarious world. I mean, if you don't know what you're doing, you're actually going to be losing money. And you're losing money doing the wrong thing. So the next advice I'll have is to have a financial advisor. It's very different if you have a partner, somebody who deals with it as a profession, somebody who knows the market, so that there would be a bit of hand-holding at the start until, number one, you're disciplined, and number two, you're more knowledgeable to get on with your own financial journey. But the more important thing is this, that they have to start somewhere and they have to start now. And on top of that, have somebody help them out. Because, you know, if there's no one that they can rely on, there can be big mistakes. And I guess, as we all say, the tuition fee becomes higher.
The tuition. Thank you for that answer, Boss Rex. Interesting. The tuition fee gets higher. Yes, I remember that saying. Boss Zed, this one is for you. What can you say about the Philippines' current state of economy in relation to the Philippines stock market?
That's a good question. We believe all economies in general are expected to reopen and hence recover as soon as the vaccine rollout reach a large enough portion of the population. Uh, and this includes the Philippines, definitely. So this is not a question of if, but of when. But however, along the way, there might be short-term headwinds like a temporary surge in cases, something like that. And while we're sure that somewhere down the road the Philippine economy is going to recover, we do believe that these short-term headwinds will happen. And Sir Rex also touched on this earlier as well. So this is why we recommend investors to diversify and look at getting some exposure to markets that may be well ahead of us in vaccine rollouts, like the US and China, for example.
Wow. Noted in that, Boss Zed. No? Thank you for that answer. Okay. This question, next question is for Boss Rex. Is there a recommended percentage for the amount of investments that you put offshore? So in other words, in your total package, how much do you think you should keep offshore or you should put offshore?
That's an interesting question. I guess that comes from someone now contemplating on taking a dip on that kind of diversification globally or maybe outside the country. I can say that the rule of thumb is anywhere from 20 to 25%. That's a rule of thumb. However, given our situation today, I would probably get to increase that by about 5 to 10 percentage points because of our situation. As Zed said, I mean, we know we're going to be left behind. So if you're going to be allocating more to the Philippines today, certainly your portfolio will not be performing as well as a portfolio that's going to be exposed to better markets, portfolio that's already into issues and markets that are already recovering. So again, going back to what I said, rule of thumb, 20 to 25%, but be a bit open to increase that a bit because of the current COVID situation in the country.
Thank you, Boss Rex. So 20 to 25% as a rule of thumb. That's an interesting way to look at it right now. Boss Zed, you have another question. Is there a distinct advantage if the team managing your funds is based in the country where the investments are being made?
That's a great question, and this is basically relates to the three funds you mentioned earlier, Wami, because all of these three funds, their fund managers are actually based where they are domiciled. So the U.S. fund, the fund manager is in the U.S. The China fund, the fund manager is in the Tiger fund, is the fund manager is in is in Hong Kong, and the Global Preferred Fund, the fund manager is in the U.S. Where most preferred securities are issued. So yes, the straight answer is definitely yes. There's a distinct advantage, and the key word there is on the ground. When you have people, research analysts, credit analysts, fund managers, portfolio managers, traders who are on the ground, they'll have faster reaction to news and updates and anything that will affect the performance of the fund and their decisions with regards to stock selection, etc., etc. So all of these things are very vital and very important to the performance of the fund. So I believe that being on the ground is indeed a distinct advantage.
I understand. So what you're saying is that when it's being on the ground, they really know what's happening, real time. They can react immediately.
Yep.
Interesting.
Yep.
This next question is for Boss Rex. What are the benefits of having offshore investments in this time of pandemic? That is the question, sir.
Well, I guess we've mentioned that many times. No, both of us, me and Zed, we said number one, it's really diversification. You're not going to be locked in on the performance of a given country and a given economy. You're going to be more spread out. So it's almost like if you have bets, those bets are going to be in different markets and in places where they can better perform. The other thing that happens, when you say diversification, probably a lot of people are just looking at market diversification, but there is a natural currency diversification that also goes with it. See, we all know the Philippine peso is very strong today just because the economy is not doing well. But when the economy starts doing well and we start to import
Yeah.
goods, we start to import raw materials, you will see that peso weakening again. So that's a double whammy as far as exposure is concerned, right? So you'll have to lace your portfolio with a stronger currency, and then that stronger currency would be the other currencies that Zed has just mentioned. Maybe China's currency and the mighty U.S. dollar. The other thing that's very important is this. Zed mentioned that technology is the driver today. I mean, it lords over all industries. You take a look at the Philippine market. How many companies can you find that's going to be technology focused in the Philippine Stock Exchange? That's going to be very, very little. I can even count them on my fingers. But if you're going to be looking at more sophisticated markets like China and the US, you'll find a lot of technology companies. In fact, you've mentioned the more popular ones, but the real other performers are hardware component makers, chip makers. We don't know their names, but they're doing very, very well as well because of their exposure to technology.
Thank you, sir. Interesting stuff, guys. Another question, Boss Rex, for you. Earlier, you mentioned one of the themes is the quest for yields, no? The quest for yields. With the emergence of deposit products offered by entities like ING, Tonic, and even G Invest that offer high yields for essentially deposits, would you recommend these over government securities which offer approximately 1.8% per annum?
We have to understand that every particular investment instrument is matched with a particular investment objective. Sometimes it's very easy to think about participating in an investment because of its higher yields. But let's begin to understand. Most of these deposit products are used to practically lure the customer. I mean, it's a quest to gain market share. And when you do that, you're actually going to be increasing your cost. So your deposit rates are going to go up because you want the clients to come in. But you cannot sustain that.
Yeah.
Certainly, all of these banks, all of these other companies, eventually will make it go down to the more palatable, the more acceptable, the more reasonable rates of deposit. Siyempre, nag-iinganyo ka. So you'd want people to get interested. But take note, they have maximum amounts and they'll probably, as I've said, lower this over time. So let's take advantage if we can, but it's not going to be something that would be a focal point in your investment portfolio.
Interesting.
Agree.
At this point, I think that's all the time we have this afternoon. So once again, I'd like to thank our speakers for answering the questions. Now, before we let them go, syempre, encore muna tayo, I would like to ask if you have any final tips, parting words for our guests today. Let's start with Boss Zed. Any parting words for our guests today, Boss Zed?
Yeah. The key word that I guess that will resonate in today's webinar, that resonated in today's webinar is diversification. So I invite you guys to diversify your portfolio. Not all countries or all asset classes will do well at any one time, and it's great to have exposure in more countries rather than just one. And let MCBL be your partner in diversifying and achieving your future goals. Thank you very much. Stay safe, everyone.
Thank you, Sir Zed, for those parting words. Boss Rex, any parting words from you?
Of course, as Zed has mentioned, it's an opportune time. It's an opportune time to revisit investments, to try and diversify. But I guess, the oldest amongst the three of us, I can essentially say that I've been through several crises. 1997, as mentioned, 2008. And when I look back, it is when this crisis happened that the most money has been made. So I'm calling on all of the people in our audience today. Think about it. Don't let this crisis go to waste. A crisis is an opportunity. It's time to act. Maybe a lot of you got insights from today's event, but you have to execute. As they say, education without execution is mere entertainment. So please do something, call on and talk to that person, give him time or her time, the person who invited you this afternoon, and maybe it can be a good step towards getting into something that will help you achieve your financial dreams.
So thank you for that, Boss Rex. Ano nga ulit yun? Education without execution is only entertainment. I'm going to write that down later. So thank you for that. Thank you once again to Boss Rex, Boss Zed. It was indeed a very insightful afternoon. I hope you guys are still with us because we will now be raffling off 5,000 pesos worth of Sodexo gift certificates to one lucky registrant. So normally, I would probably pull the name out of a hat, but we have that prepared. Congratulations to Miss Kathy C. Miss Kathy C, you are our winner for 5,000 pesos worth of Sodexo gift certificates. Please stay tuned, or a representative from MCBL will get in touch with you soon on how you can claim your prize. So congratulations, Miss Kathy C. You have won 5,000 pesos worth of Sodexo gift certificates. Thank you. So now, we'd like to thank everyone who joined us this afternoon for taking time out and for actively participating during the webinar, during our Q&A segment, during our poll. As you set your short-term and long-term financial goals, we hope that our offshore investment funds can help you achieve the financial success you wish for yourself and your family. And that wraps up this afternoon's Financial Wellness webinar. This has been your host, Mr. Wami Havillana. We hope to see you in our future webinars. We'd also like to hear your feedback on this afternoon's webinar. Simply scan the QR code being flashed on your screen and kindly spend time to answer our 2-minute survey. Maraming salamat po. Stay safe, everyone, and have a nice weekend. See you all.
Manulife and China Bank. Two companies you can trust. Two top institutions in the financial industry. Teammates, partners, working together to handle every aspect of your finances. From day to day to your future plans. Personalized to your story, so you're ready for life's every twist and turn. We have you covered, starting with your kids' dreams to providing a secure future for your family. Working to build your wealth and ensuring your wealth works for you. Always with you in sickness and in health. Through the best times and the worst. All just for you. Let us be your partner. Manulife China Bank Life. Life with a plan. Let us help you get started today.
You deserve the best life. You work hard. You know the formula for success. Your options are wide, but few make the cut. We can help you make the most out of life. Because you deserve the privilege that comes with building an elite life. Introducing Manulife China Bank Life Affluence Max Elite. This one-time investment in life insurance plan provides you with a startup bonus that would optimize your funds on the onset so you can enjoy rewards now and in the future. Experience the Manulife China Bank Life Advantage. Let's say you put in a one-time investment of 1 million pesos. Manulife China Bank Life will give you 1% of that as a startup bonus. This increases your investment by 10,000 pesos. Get a loyalty bonus. If you stay invested, you may have the chance to get a loyalty bonus on the 10th, 15th, and on the 20th year. Enjoy hassle-free application through a guaranteed issue offer. This means that there would be no need for medical examinations if certain conditions are met. Get a boost on your investment by making additional investments anytime. Enjoy peace of mind with life insurance coverage. Invest through Manulife China Bank Life Affluence Max Elite. Get an early reward and look forward to more.